So Goldman, then, the opposite of Wells Fargo, pretty much all institutional banking. They do strictly have a consumer arm, but they mostly get their money from global markets, from investment banking and from asset management. So the kinds of things that are a bit more investment banking in nature. Their revenues were down 16%, so 10.6 billion. Their earnings per share were down 39%, $3.32. Did that surprise you at all? Obviously, there were huge misses in their kind of investment banking section. Kind of what you were expecting here, Steve, or not so much?
I think actually it's probably better performance than I expected. I really like Goldman Sachs as stocks. I used to own it, but I sold it after it jumped up quite a bit, quite quickly as well. And at the moment, it doesn't really seem like EPS of sort of $3.30 odd it's going to look really, really expensive soon. And I know we're going to head towards. It's nearly a $400 stock off the top of my head, isn't it? Is it $390 or something like that? 300
and something, yeah. I'm not sure. So I think it might be a bit lower than that, but 300 and something.
It's going to look expensive rather quickly for a bank. So I wonder what's going to happen with that valuation. I wonder if the market will obviously understand the situation it's in, or whether it will give it the immediate punishment it probably deserves. But yeah, not particularly surprised about this. I always think of Goldman Sachs as it's an investment bank first and foremost. It's a consumer arm, although they're making they're increasingly looking like they're going to try and get rid of this consumer arm, maybe ship it off to somebody else, or make it a lot smaller than it is. But yeah, investment bank first and foremost for me. And when there's just this environment of almost zero investment activity going on, to lose only 16% of revenue, I think that's pretty good.
Interesting. I thought 16% revenue loss was okay. EPS 39%. Wall Street was surprised by this. I know we don't, and I've made a point so far of not calling them beats and misses and so on. It was their biggest miss in a decade, I think, compared to what Wall Street was expecting for their EPS. So your kind of positivity wasn't shared by the street. Who the hell cares what the street think? For my part, I was surprised by this a bit, actually. I mean, I get that, look, this is a cyclical thing. Obviously, things are going to be worse. So the revenue line took a hit. Around 45% of the business, the investment banking, the asset management stuff, is sensitive to what's going on in the SPAC and IPO market. This is a bad time for that. That's just what you sign up for with Goldman Sachs, right? There is no point complaining that things are going badly when IPOs aren't happening and SPACs are a thing of the apparently distant past. But what I was surprised by was that Goldman wasn't prepared for this better. Why their costs weren't under control a bit better. So their main cost they have at a bank, being any bank, is wages, effectively. And that's something they are making moves to correct kind of now in January. I say correct. What I mean is, unpleasantly, they're firing a load of people. Basically, because if there isn't the demand for investment banking, you don't need as many investment bankers sitting around. When no one's coming through the door saying, look, we want to take this public via a SPAC, or we want to launch an IPO, the hell are you paying all these people for? You can't, effectively. And Goldman is attempting to right-size itself. I'm surprised they didn't do that faster, for what it's worth in my case. And, if you're Goldman, you are well used to this kind of thing. You are well used to there being... I was going to say times like 2021 in particular. They sort of were on the way down in 2022. I'm not sure there'll be a time like 2021 quite again in either of our lifetimes. I think that was a very much a perfect storm for an investment bank. And people who were getting excited then and saying, well, look, this should trade at a PE of 20 and therefore be a $1,000 stock. Even the likes of you and me tend to think, you don't stick big multiples on cyclical things when they are at the best they're ever going to be in their cycle. I mean, this isn't just high, this is kind of extreme high.
Yeah, it's like sell your course level valuation, that, isn't it, I think. Yeah, so I agree with you completely, really. And I think there's two schools of thought in terms of when you're doing a layoff. There's you get ahead of it and you get your layoffs and you minimise the downside, or you keep your good. If you feel like you've got a really good team and you don't want to let anyone go, you keep your good team, and then you're ready to sprint off the minute the investment banking landscape sort of sweetens up a little bit. And it's been a couple of years now, really. Well, we're into the second year of a bad investment banking landscape. This won't last forever. And you're noticing that the banks and even the Fed, to a degree, are starting to change the tune a little bit on this. Like, recession is coming. It's going to be the worst recession. There's massive economic headwind. All of that narrative is now changing, and it's just sweetening up a little bit. And if we do miss a recession, if we do manage to get out of this scot-free, if we get this soft landing that that has been sort of touted by idiots on this podcast, Goldman will be really, really well positioned to just race off into the blocks when all the IPOs start again. I mean, this isn't going to be the thing that brings Goldman down, if you see what I mean, unless this is protracted for 5 or 6 or 7 years. But I just don't see that as being the case. I think they're kind of realising being a retail bank is probably too expensive. They don't want to do that. They want to keep in asset management, they want to keep in investment banking, and they want to keep in trading markets. And I think that's a healthier Goldman, probably slower growing Goldman, because we're not having a fourth sector. But I think that's the kind of Goldman that I would want to invest in again. It's just a little bit expensive at the moment.
Yeah, you beat me to the question then in that case. I was going to say stock is down a bit. It's not down as much as its revenue and earnings are down, but wondering about whether that might start to come down more if we get a few lower earnings calls, and whether that might be getting interesting. It feels like the time to be looking at these things anyway when people are looking the other way. I mean, I'd be very wary of just looking back 2 years and saying, well, look, it goes up there at the top of the cycle and it comes down here at the bottom of the cycle. It'll be great when it's up there, because I'm not sure we'll see 2021 again. But looking at it when there might be scope for things to get better. I don't know how soon, but yeah, I kind of got an eye on this. I'm planning on looking a bit more closely.
Well, that's it. The problem is that a bank like, if you're looking at something like Wells Fargo, you can see a bank there where things got worse, and then you can see sort of like, and you can reflect that in the share price as well, and you can see like where it's going to, where you think it's going to start to get better. Perhaps now is the time that you think it's going to get better. So there's some optimism, but you're starting at a low base. But with Goldman, I have optimism that this is going to get better for them, but they're already at a high base. In fact, that their results were, I say only 16%, but they only fell a couple of percent on the day. I think it ended up might have been 4 or 5% in the end, but that was not, those results were not worthy of a 4 or 5% drop. It should have been double that. I would have guessed off the top of my head, but it's strange. I guess they must see, and I wonder if David Solomon at Goldman is perhaps under a little bit of pressure, because his plan was to bring retail banking to Goldman Sachs. That was what he wanted to do, and he's now not going to deliver on that. And now his investment banking arm is down as well. I mean, it's very unlike Goldman Sachs to go cutting CEOs. It doesn't happen very often at all. But I wonder if his seat could just be getting a little bit warmer at the moment. Yeah,
it's an interesting mistake, and it is a mistake that he's come out and said that didn't go as well as we'd hoped it would. He put it on trying to do too much too quickly. I think the big advantage for something like Goldman from a retail arm isn't that it will particularly start turning itself into a JP Morgan or Bank of America type thing, but it does give them a kind of access to capital which will make them more efficient on the investment banking side. So you can't just take in customer deposits and then go and use them for trading. It's not quite as straightforward as that, but there are certain capital ratios that you're supposed to maintain since sort of 2008, and to say things got out of hand then is a bit of an understatement. But using customer deposits can in some ways help to offset that and help to give them a bit more ammunition to use in trading. Their trading revenue is up for what it's worth, and they are considered, I think, to be the class of the field when it comes to a lot of these investment banking and trading activities, along with JP Morgan. Citigroup, depending on exactly what you're looking at, they tend to be very good at fixed income and not very good at basically anything else. And Morgan Stanley are another one who Morgan Stanley I always forget about when I write down these bank report things, so nothing coming on them for anyone that's waiting. But any final thoughts on Goldman?
None really. I was going to say just quickly on Morgan Stanley, their results were pretty good across the board. I think they were up 7% on the day their earnings came out, so they were they looked pretty strong. They're a little bit broader than Goldman Sachs in terms of their investment banking, so there's They did fairly well out of it. But yeah, Goldman, I mean, it's a stock I like. It's a price I don't like. I wish the price was a price I liked, because it's a stock I'd really like to own.